Namaste and welcome to the Bharatvaarta podcast. Over the course of this week, we've all been consumed by this phenomenon of Redditors banding together and buying up stock in this company called GameStop, orchestrating what is known as a short squeeze, much to the chagrin of some of the hedge funds that have taken a short position on these stocks. And if you, like me, don't really know how some of this works, well, don't worry. We have a couple of folks who live and operate in this world today to give an insider's perspective on how this big bad world of hedge funds and whatnot works. We're joined by Rajiv Gupta, who's an experienced options trader. Hi, Rajiv.
Hi.
We're also joined by Dhiraj, who is choosing to stay anonymous for compliance reasons. Hi, Dhiraj.
Hi. Hi, Roshan. Thanks for having me.
Yeah, so needless to say, none of what is said on this podcast should qualify as any kind of financial advice and are merely observations. So with that out of the way, I think we can get started. Dhiraj, let's get into this straight away. Can you explain what the hell has happened with the whole GameStop phenomena?
So GameStop is essentially probably a business model which a lot of institutions feel is broken in today's world. So they essentially trade video games. So eventually such companies people expect should go into bankruptcy. So they try to run a short on them because then you can make money by selling those stocks. So shorting something is when you sell a stock what you don't own. So either you borrow it or you can buy put options. Put options are something which gives you a right to sell it at a price, or you can sell call options, which is you're giving away the right to sell to buy the stock at a predetermined price to somebody else. So so some of these hedge funds who would have done probably their research and would have thought that the business model is broken and would have shorted the stock, and they would have amassed a meaningful proportion of the free float as short interest. So short interest is total amount of stock which is shorted as a percentage of the total stock outstanding or as a percentage of free float. Free float is essentially stock owned by non-promoters, right? Now, what happened is that on Wall Street bets, people figured out that there are few funds who have meaningful short positions, and then they put it up, and like this particular forum probably has a lot of users, and they just put out the idea that if everybody starts buying, then the stock goes up, and people who are short will have to cover, because essentially the amount of stock outstanding of a corporate is a finite amount, right? You cannot create stock unless the corporate decides to issue new stock. So so when people start buying, it's demand and supply. It's a number, right? So at the end of the day, so when they start buying, somebody has to sell, but there's nobody to sell, right? Because people who had the inventory or the position, they have already given the position away to the short sellers who already sold it to somebody else.
Right.
So what and also what happens is that if, let's say, this short position to start with would have been a meaningful part of the fund's exposure. Let's say the fund's assets are 100 and they were short $5 or $10 worth of GameStop, but let's say the stock goes up 2x or 3x, that's a direct loss to them, right? So and the NAV falls to the same extent, right? So the 100 NAV becomes 95 or 90, but if the stock goes up 10x, then you can theoretically lose half your NAV if the starting position was 5%. So at every point of time, you'll start getting margin calls, and then you are forced to buy. So it kind of becomes like a frenzy where the Redditors are buying, and then the funds who are short also buy. So it becomes you may call it a virtuous cycle for the stock price, but kind of a vicious cycle for the shorter, right? I think that's what's happened here.
Right.
And that's what happened in a few other names where people thought that the business models are relics of the past. Right? So Bath and Beyond, or Macy's and AMC, which is a studio. So I think this is just a function of demand supply. So if you think of these things as numbers and don't think of them as stocks, it's just demand supply. People are buying it, so it can go up, right? So we have seen this happen in commodities, right? Silver prices in 2011 went to, I think they went to $50, right? At peak, Rajiv, am I right?
Yeah.
So there's no logic to silver being at $50 or $10, right? But it's a number. When people are buying it, it went up. So it's the same thing happening here, in my view.
Okay, so let's simplify this a little further, for people who are listening to this. Rajiv, Dhiraj brought up, short selling, calls, puts, a bunch of other things, right? Now, can you give us a 101 of this, maybe back up a little bit, explain short selling to us and all these various terminologies, and also how this impacts the market as such?
So short selling, the whole concept is that, say you own a share, GameStop share for $10. Another person believes 10 is too expensive because the company is committing fraud or the business model is redundant or can be a lot of reasons. So what they do is person A owns the stock, person B borrows the stock from him and sells it for $10 so that if it drops to a value of 8, he can buy it back from the market and give it back to the person he bought it from. In this specific case, the issue was that so the person B borrowed the stock, sold it to person C in the market. Person C was holding the stock. And now person D borrowed from person C and sold it again in the market, not knowing this is already a borrowed stock, which person. So what happens is, in a real scenario, the open interest or the amount of stocks which you can sell should not ever exceed the number of stocks available. And that's the percentage which Anshu was talking about. It should never be above 100%.
Right.
And in a regular scenario, it's normally not above 50 to 60%. But in this case, the open interest went up to 120, 140%. So the market was short more stocks than were actually available in the market. And unfortunately, Melvin Capital had to post its long put position and the short stock position in the SEC filing sometime late last year. And the Reddit forum picked it up. So they have the exact position which this fund is short now. And they had the short interest ratios. So they know exactly what stocks they can buy to squeeze them up. And this is where the scenario happened. And then there are a couple of things to add fuel to the fire. Ryan Cohen, who's the founder of Chewy, he was added as a chairman to this GameStop company, and people believed he will actually turn it around. So there were some national long buyers as well. And then, unfortunately, it's not a regulated forum. So on Reddit, there was a person, and this is the mystery. He posted a Chernobyl video where they have how we will blow up Melvin Capital, and this is how the story is going to be. And that is what triggered the whole fallout starting January, I think, 4 or 5. So short, I think, does have value because in the past, because of benefit, it's a very risky strategy. Because if you should sell GameStop for $10, you can make $10. But if it goes to 400, where it is right now, or 330, you lose $320 to make 10. So it is a very risky strategy. So it is not recommended for retail, and hedge funds do it, and it has proven very beneficial in the past. Like it was a very early warning sign for Enron when it collapsed because of fraud. So they do add value to the market, but yeah, if they're disclosing those positions and they're doing it over excessively by getting the short interest above 100%, then they're setting themselves up for failure.
Right. Can you also explain this concept of short squeeze that we keep hearing about, which is it's just the opposite, right? Basically, if someone's taken a short position on a stock, you do the opposite, essentially buy up all the shares. So they essentially have to buy to you and you command the price. Is that right?
That's right. So what happens is if you own say GameStop stock and I borrow it from you and sell it to the market, at a particular date, once the stock falls, I can buy it from the market and give it back to you. But what happens if the stock rises? If the stock rises, I still want to buy it back from the market and give it back to you. But it is not a squeeze situation yet. The issue is when I'm short 120 stocks and there are only 100 available in the market. Me and my friend together, I'm short 60, he's short 60, and total stocks available, which are long is 100. And the stock goes up. And it triggers me to, hey, I need to buy the 60 shares back from the market and give it back to this guy because my strategy is done. I can't make money from here on. So I go and buy those 60 stocks, but my friends which triggers my friend's 60 stocks he needs to buy as well. He tries to go buy 60, but they're not available in the market. And then we're just racing with each other to buy these stocks back. And now a fourth person sitting on the sidelines sees that what's going on. He starts buying in front of us from the only sellers in the market. And that creates a short squeeze and stocks can go up 1,000%.
Wow.
It is different a little bit from what traditionally used to be called a pump and dump situation, where people would get together, they would come up with stories that why the stock should be 10 times more, and they would start buying and spreading rumors. And when it would go up there, they would sell it to all the innocent people. That is slightly different. This is more of a short squeeze caused by people trying to sell a company which they don't believe in the business model, and people figuring out their positions and then, messing it up for them.
Right.
And the short squeeze can also be triggered by, as I mentioned earlier, when you start having margin calls, because you start having losses and you have to make good the losses, right? So funds will not be able to make good the losses beyond a point.
Right. I'm sorry, I'll have to ask you this again. Can you explain margin calls for us, Dhiraj? I mean, as you just referenced.
So let's say my fund has an asset value of $100 and I'm short GameStop worth $10 out of that, and the stock goes up 3 times, so I have a loss of $20. So I have to make good the loss, right? Because GameStop is not the only position in my portfolio. So
Right.
how do I make good the loss? Of course, I can sell something else, or I can reduce my margin requirement by buying back GameStop, right?
Right. Right.
So I have to do a mix of things, and which is what probably happened in the market, that people have to buy back their shorts which are going up crazily, as well as sell their other positions to create cash, which is why I saw a little bit of weakness in the overall market outside of the stocks which were going up crazily, right?
Right. So, let's assume that this performs a valuable function of, let's say, price modulation, right? I mean, or price discovery per se. There's a stock that is overvalued for some reason, and, you want to bring it down to gravity. And so, people can take a short position on that and sort of even it out, right? But it also has all of these other consequences and possibilities of market manipulation and things to that effect, right? So I wonder if, the both of you could speak to that.
Yeah, I can go first. So for market manipulation, the thing is, this strategy used to be working in equity markets back in the days. I mean, in India, it worked with Harshad Mehta. In the US, it has worked in the past. And a lot of regulations have come into place to monitor and track this activity. SEC is an agency in US which really makes sure this doesn't get exploited and manipulated. But the issue is they monitor the people who make money or who make winning bets in such situations. So the funds and the banks. And the retail normally ends up being on the losing side. So SEC doesn't pursue them and doesn't try to sue them for them breaking the rules because they end up losing anyway. This, I think, is one of the rare scenarios where actually the retail did win by manipulating the market. And the same rules do apply on retail. So it would be interesting if an agency like SEC can actually go after them now and say, hey, you can't pump and dump, you can't short squeeze, you can't front run. These are all illegal activities, and you should have been aware of them before you got into the market. And so it is manipulation, but from the retail side, and that is harder for a regulator to actually bring back in control. On the commodities, as Dhiraj was saying, it's different. The regulation is very different, and you can still squeeze it, but there the players are bigger. They're manufacturers and producers and all those people involved who can keep the prices back in line. They can actually take deliveries, and they can use the silver for something else or provide the silver by mining it. So there, it's a free for all, and you can do whatever, similar to crypto. But SEC arena is very well regulated, at least for the funds.
Right. Right. So in essence, SEC was not built to regulate retailers in the first place, right? I mean, they're built to regulate the large institutions, essentially.
Yes, that's right. But the rules apply on both sides, and they would go after the large retailer as well. It would happen in the flash crash scenario back in 2010. And Navinder Sarao in UK he didn't go to jail, but he got massively fined for, as a retailer, he was doing an illegal activity of what is called spoofing. So they can, in theory, go after them as well. But yeah.
Right. Yeah, I mean, it is an exceptional situation where, people bandy together and sort of do this coordinated sort of an action, right? So Dhiraj, I'm wondering how much of this is allowed in India, what happens in India, I mean, could you talk about this whole context from an India perspective?
Yeah, sure. So India is far better regulated and organized for shorting than US. And it is also much more difficult in India to reach kind of concentration exposures what Melvin Capital reached. So in India, there are 2 ways to short. So one is you can just short single stock futures. So there are around 200, 300 stocks out of maybe 5,000, 6,000 listed in India, which are single stock futures. You just sell those futures, and that's about it. And the second way is you go to the SLBM market, which is like stock lending and borrowing mechanism, which is again an exchange traded market. So you can borrow stock for a finite duration, 1 month, 3 months, 12 months, from other counterparties. You pay them a borrow fee, and then you sell the stock. So you can borrow stock for a finite duration, 1 month, 3 months, 12 months, and the stock is then transferred from their depository to your depository. So in India, every stock is held in either the
broker,
two
right?
depositories. No, in India, stock is not held with brokers.
Sorry, yeah.
That is the scenario in US. So US stock is held with broker participants who can then borrow out this, lend out the stock to other clients of theirs who are looking for borrow. But India, stock is held in the investor's account with one of the depositories, NSDL or CDSL.
Okay.
And if you want to borrow stock, then you have to borrow the stock on exchange from that particular investor, pay him the fee on exchange, and transfer from his depository account to your depository account, and then you can sell it.
Right.
I don't think, Rajiv, just correct me if I'm wrong, I don't think US has a central depository system. Like stock, in my view, stock resides with each of the brokers, right? So
I mean, there is a DTCC, which is supposed to be the central repository, but I think the T+2 settlements, what that means is the stocks which I buy today actually hit my account 2 days later. It's not real time. I think India is slightly faster. That creates a lot of mess around. There is a central repository, yes, but it just doesn't work as efficiently as it would in India, I think.
But for borrowing, do you have an exchange trade market like India has, where you have to...
No, that isn't with the brokers. You're right.
Yeah. So because all the borrowing done in India is on exchange, and the borrowing market is actually not very popular in India because single stock futures are far more liquid and easy to trade around. So because of these checkpoints, you can never be short more than the free float, right? Because you cannot sell what you have not borrowed.
Right.
And you can borrow only what is there in somebody else's account. On top of that, if you were, let's say, shorting single stock futures, there's also the regulator in India has been very, very prudent. So they've set limits. So the market-wide position limits on a single stock future is capped at 20% of the free float of that stock. So all participants in the market put together, their outstanding contracts, futures, options, everything put together cannot be more than 20% of the free float of the company. Free float is essentially total number of stocks held by non-promoters. So by design, the short interest cannot be more than 20% of free float, right?
Right. So essentially, there's a limit to the leverage, basically, right? In comparison.
It's not a limit to the leverage. It's the limit to the amount of stock you can short. So this is the market-wide position limit, which is a limit. On top of that, a single investor cannot short more than, I think, 5% of the free float.
Right.
So essentially, you will never reach a scenario like what happened in US in India, because those safeguards are already in place and everything is exchange traded. Hardly anything which is OTC in India.
Right. Okay. So, let's take a step back. And Rajiv, I have a more general question. People have so much angst against the hedge fund folks, right? I mean, they're described as causing all sorts of catastrophes, from bringing down companies to, causing social unrest and so on and so forth. And if you look at some of the rhetoric online as well, I mean, it's very much against the, rise against the system, so on and so forth, right? How many of these tropes are sort of valid, and are people overstating the impact that hedge funds do have? If not, what do you think about this?
I've always seen that there are a couple of reasons why this becomes an issue, especially in a general crowd. One is definitely because hedge funds manage high net worth individuals and like really serious money, big money. And most people don't even have access to the kind of minimum ticket size of $50,000, which is required by a lot of funds to be invested there. And that makes it a very non-populist kind of or very high entry barrier kind of a strategy. And yeah, if 99% can't participate in that, it's a mystery. That is how rich people got rich. It just doesn't look nice for anyone for those funds to exist. But that being said, there have also been scenarios where genuinely the fund managers, because of their assessment, which may be incorrect or not in line with the founders or the promoters of the company, they would try to put them back in line based on their expectations. And I think a very good example is what happened with Tesla. And Elon Musk absolutely hates the situation of the shorters trying to short the Tesla stock, because they almost drove Tesla out of business twice in the last 5-6 years. And the logic I think Elon Musk had was, I have this much timeline to prove that this is a valid business model and how we will become profitable. And the funds didn't believe in that business model. So there's a disagreement. and he needs this time of 5-6 years. But what happens is if the funds drive the stock prices down, it becomes hard for him to borrow money. It's a cash burn business in those years. It becomes hard for him to borrow money. It becomes hard for him to borrow equity or debt. Everything becomes expensive as the stock prices drop. And it makes very hard for a cash burn business to keep on evolving. So a founder, a business manager versus an investor, or not investor, a hedge fund manager, they can be in conflicts, and these businesses can, based on their limited sight or vision, can drive down businesses to zero. So there is some genuine reason why I think this business is not liked either, especially the short selling hedge funds. Right. I think Dhiraj can comment on this more as well, because he has a little bit more experience with this.
I think I agree with Rajiv, and that is probably one reason why Elon Musk has jumped into this, right? Because he was given a lot of grief by these guys, right? Almost driving Tesla bankrupt 2 or 3 times in the past, and that's why I think there's general angst against funds amongst corporates, because they, maybe for genuine reasons or otherwise, hedge funds can shorten their lifespan. And I think other than that, it's maybe something to do with the lifestyle they lead and general public persona, right? So if you're going to flash around your wealth, and then nobody likes it, right? So it's nothing to do with just the hatred for hedge funds, right? People don't like Adani Ambani in India, for example. So it's the same thing.
I think the added impact is the fact that people think, the finance guys don't really produce anything, right? You don't really make anything, which again, I mean, is one simplistic way of looking at it, obviously, right? There is this whole risk and credit aspect to that, right? But what do you see happening as a result of this, Dhiraj, in terms of institutions itself? What is the impact of this whole GameStop phenomena? Are they taking this as seriously as all of us are interested in this matter, or I mean, it's something that they've seen before and will pass off?
You mean the hedge funds?
Yep.
I think they will look at it. They're going to probably learn from it and probably be more cautious in shorting microcaps. In the US context, all these companies are microcaps, right? So, and then you short a large proportion of that. So they're going to adjust the strategies. And I don't know whether you saw that, like Citron came out with a video release today that they're going to stop putting out short selling reports, and there's more money to be made on the long side. So essentially, what often happens is that it's not only when you're short selling, it's not only fraud that you short sell, right? So you also try to imagine scenarios, and then you try to promote your short, right? So just like somebody promotes a long, people can promote the short as well, right? So I think maybe it's just going to be more fundamental driven in medium to large caps, and people are not going to become too big in some of the small micro caps, right? So like GameStop at its low would have been less than $1 billion market cap, right, Rajiv?
Yeah, it was about $2.
Yeah. So the point is that, but the fact of the matter is that a stock can fall 100% from any level. So you can short GameStop at $2, but you can still make 100% on it. But shorting is asymmetric because the maximum upside you have is 100%, but the downside can be whatever, right? It can be a million percent as well. But a lot of these people, they probably didn't factor in somebody like a Reddit forum and millions of investors squeezing them. But that was never a part of their analysis. But I think in future, they will build that risk in, right? And then they would adjust their positions accordingly. So
right,
maybe they'll not short stocks which are less than $2, $3, $4 billion maybe. Or if they're short, then they would limit the position size to 50 bips of the fund, like less than 1% of the fund, or they would have a risk control, right? So everybody controls, has position size limits. And I think that's what's going to change in the internal risk departments of these hedge funds going forward.
Right. At the very least, I think they'll have a couple of analysts combing through all the subreddits, I think. So, Rajiv, on the retail side, what should investors beware of during these times? I mean, you upfront, you mentioned that, this is not a game that retail investors should play, right? But we're seeing a lot of this activity, and there is this whole, movement to stick it up to the system and stuff like that. But I mean, at the end of all of this, there could very well be some retail investors who lose a lot of money, get wiped out and stuff, right? I mean, so what would you advise, or what would you say to these retail investors as such?
Yeah, I mean, I would stick with my advice. Stay on the sidelines. Don't participate. Whether you're on the long or the short, you can get in trouble either way. I mean, I know there is FOMO. This is the loudest topic out there in the news channels. Finance or politics, it's still the same topic. But the issue is that this cannot end well in the end. I mean, the people who will make money will not be the retail. There will be some retail which will make money, which have been sitting since 2019, who were patient and value investors and had a reason to be there. The new entrants, they will not. The people who will make money is people like, so when we are talking about the short funds, the Melvin Capital and the Citron, they were the long funds. There was the Mike Burry, the guy who called the from the long shot. He was long at the Ryan Cohen, the founder. He had 17 million shares. He was long at. They are all selling to these short sellers. So there's a fund long, there's a fund short. They are being matched. The hedge funds are losing. These hedge funds are making. Similarly, on the retail side, they're a really smaller part of the picture. Mm-hmm. The patient investors sitting since 2019 would make money, and the new buyers who come in now trying to buy the stock at 300, 400 prices, they're going to lose all the capital. So it's in the end, it's a casino. Do you want to be part of it right now, or do you just want to stay on the sidelines and just observe it? Being long, you can get in trouble with SEC. Being short, your broker might just say that, oh, you know what, I do not have any stock to lend it to you. You know what, I'm going to hack your position, whatever the level, I don't care. So you are in trouble either way. You saw the situation with Robinhood. Brokerages they stopped completely trading the stock, but they also liquidated positions which couldn't manage the margin. They also they could have just called a margin call by changing the risk model and saying, it's too risky, your short position or your long position, so I'm going to close it for you. A lot of things can go wrong. There is literally zero benefit of participating here.
Right. Dhiraj, on a similar note, what do you make of Robinhood's response to block trading?
See, I don't know exactly what the issue was. I saw an interview by the founder, and it was kind of didn't enlighten me, because if the issue is because they're not able to meet margin, they can always collect margin from investors, right? That's how I think it should work, right? Because at the end of the day, if you were providing leverage on these stocks to start with, that was silly, because the volatility is so high that these stocks should have, they can fall a lot, or they could go up a lot. So they should have been 100% margin to begin with. So I think instead of stopping, this is my personal opinion, instead of stopping trading, they could have just collected upfront margin from anybody who wanted to buy, and then submitted the margin to their clearing agent, right? So it just, I think it's just circumstantially they're in a bad place because of their relationships with some of the short sellers, right? So it just, maybe they didn't have any bad intentions, but the circumstantial evidence just brings a lot of bad PR for them because of this. But they're not the only ones who have stopped it. I think Interactive Brokers has also stopped trading all of these names.
Every brokerage firm in the US stopped it, other than investment firms like E-Trade and Fidelity, you could buy them. But every other firm, from Webull to Robinhood to E-Trade, E-Trade was fine. Actually, Interactive, all pure brokerage firms had to stop trading this. Right. And I have heard two versions of the story. One is the conspiracy theory that the bigger funds and the hedge funds and the banks forced these brokers to stop these names so that they stop losing money. That I don't believe can be true, because a lot of these funds like Citadel actually make money with this volatility and the stock going up and down. So it's very hard for me to convince myself that actually Citadel, which has a big revenue maker for Robinhood, asked Robinhood to switch it off. That doesn't make any sense to me. But on the other hand, the reason which the founders have given for both for Webull and Robinhood is that their clearing happens with the bank, right? And the banks have this T+2 settlement system where if you buy a stock today, you get it 2 days later. If you sell a stock today, you get 2 days later. You close the books like that. And for the 2 days, if all the longs on Robinhood and all the new retail shorts are coming on Webull and both clear with two different banks, it creates a weird system of margin where, okay, Robinhood can still manage things, because if it's a $10 stock, they can just ask the buyers to pay $10. But the seller of $10, how much margin do you charge him? Because you can't take $10 from him because stock can go to 400 and this person may lose 390. So the margin model on the short side, the naked short side, is where it becomes really tricky. And if all the buyers are on one brokerage and all the sellers on the other brokerage, the seller brokerage cannot take that flow, and the clearing bank will basically say, no, you have to stop trading this name. And then this will flow down to the long side as well, that, hey, I cannot manage the margin on this side either. So I have to stop trading this here as well. So that is the story which they have stated. It makes sense. But yeah, it could be either way. Maybe there were some conferences behind these cigar-filled cubicles where they decided that, you know what, we'll get this back in place and put the retailers back in place. You don't know the details. I guess there are some lawsuits in there now. We will know soon, hopefully, what exactly happened.
Yeah, I think users have filed
I
a
think
class
my view is
action
that
lawsuit.
my view is that, Rajiv, if there was a problem in settlement, right, then maybe everybody should have gone to the SEC or the exchanges and just block trading for everybody, right? So I think the issue here is selective blocking. How can it be cleared for a particular set of investors and not cleared for others, right? So I think that's the underlying issue, right? So if there's high volatility and random things are happening and which is making it difficult to deal in the stock, then maybe just take it off, right? And for everybody.
No, so the thing is, you can't take it off for everybody for two reasons. One is you have to give them an opportunity to close their position. You have to keep it open for all closing. For open interest, the banks which can manage, which do not have any, because again, as I said, DTCC is the central repository which manages a lot of these things. And if supposing E-Trade has a lot of long people in the platform who've been value investors and have the GameStop stock out there, they have the inventory to loan this out. But Robinhood doesn't, because the new sellers come in and they don't have enough long inventory, say. So it does become at a brokerage level, unfortunately. But yes, the fact it happened in such a coordinated way makes me feel there was some higher force acting behind it.
And because, see, the point is that they should have banned short selling then. The problem is that they banned a fresh long.
Yeah, because every fresh long created a short sell. But yeah, that's too technical. I think we can.
Yeah.
No. Can you explain that again, Dhiraj? I mean, what do you mean by that?
So essentially, if you're buying a stock, then your risk is finite, right? And as a broker, you can collect the upfront risk from me in terms of an upfront margin. So let's say I'm buying a stock for the GameStop stock for $300, then you just collect $300 from me as margin. So let's assume as a broker, I'm worried that the stock can go to zero. So it doesn't matter from a risk perspective to Robinhood because I've already put the entire margin upfront, right? So so the trouble here is that they banned a fresh long, which in my view doesn't add to any risk or any risk which cannot be mitigated very simply, right? But just charging a high margin. I think that is why a lot of people are worked up about this.
No, but the thing is, they also banned the fresh short, which was a few days ago, because security became unshortable for the last 10 days. So it's not like they just banned the short that you can't just go and sell the stock because there is nothing to borrow. It's short interest is really high.
Yeah,
and that was in place for 10 days with every brokerage. And then the long, the problem is even then people figured out ways via options, synthetics, what is called, to get into short. So they had to buy the longs as well, because for every long they have to find a short because it wasn't coming from somebody's long inventory. It was creating a new short open interest by retailers. That is, again, all hypothesis. I do not know for certain. I think, again, this will come out in open at some point. But this is my hypothesis right now.
This is anyway for the higher ups to figure out, right? So we can only speculate.
That's right.
Right. So what do you guys make of, people like Chamat and Elon getting involved? I know, Elon has an axe to grind against the short sellers. And also, Chamat is a bit of a contrarian sort of a person anyway. But how do you see the impact of these folks joining this entire melee? Rajiv?
I really think so. I think the media, the politicians, everyone is seeing it as a battle between the retail and the hedge funds.
There are some strange factions forming, right? So this morning I saw AOC and AOC and Elon in agreement, which again,
Absolutely. No, and that's what I see as well, that we are seeing it as a retail versus, or the market is seeing it that way. My opinion is this is more of a fight between tech and finance, and less between a retail and a big player. I think most founders and early investors in technology companies do not like how finance approaches or the banks approach their businesses. The ridiculous fees they charge, the short-sighted vision they have, the way the payoffs work, which are on short-term returns rather than long-term vision and growth. So I think there's always this conflict. So you see everyone on the long side or against the finance is more technology, even including Michael Burry. Like they are more on the believe in technology, believe in longer-term vision. And the other side, the shorter side, is the HFTs and the hedge funds who really think about the next year and how to get the bonus out this year. I think it's more of a battle between those philosophies rather than a retail versus a big player kind of a thing.
Right. Very interesting. So, Dhiraj, we've had guests on the podcast earlier, and, we've had half of them argue for like a buyer beware approach, and half of them argue for a seller aware approach, right? I wonder where your views fall. What should be done to protect retail investors from a regulation perspective, and also, give enough scope for the necessary financial innovation and things to that effect?
I think you cannot stop anybody from buying or selling what they want to, right? So I think the only thing which needs to be done is to ensure that nobody is posting false information or manipulating the market. And I think most regulators globally anyway do that. Regulators cannot prevent that preemptively always. And as a retail investor, then it probably makes sense for you to do your research before you get involved, right? And if you don't have the time to do it, then probably use some ETFs or some low-cost funds to do it. I think that's what I would suggest, right? So at the end of the day, if you look at the markets, like over a 20-year cycle, maybe 90% of the corporates don't exist, right, after 20 years. So you will have risks, right? That's why the reward is there, right? So otherwise, the risk-free rate in the Western world is zero. So if you want to make a little bit of extra money, they have to take the risk. But probably, if you don't have the capability to do analysis yourself, then just give your money to an ETF or some low-cost fund. Right? That's what I would do.
Right. We're seeing record levels, Sensex, Nifty, so on, right? I wonder if you guys have, I'm sure you guys have an overview of the market here, right? So how do you see the India market panning out? This is a question to both of you, Rajiv and Dhiraj.
Maybe it is just, I don't have a choice, but I'm extremely bullish on India from a structural basis. So if you look at the global equity markets, there are very few countries who have really created new businesses and entrepreneurs, right? And if you think about the breadth of the market, like US keeps on coming up with new corporates, new technologies. Maybe other than that, India probably is the only country, right? How many new corporates have you seen coming out of Europe, for example, in the last 10 years? Or let's say Southeast Asia, right? Have you heard of a single new interesting company come out, right? So the good thing about India is that people are hungry and corporates keep on innovating, and they're entrepreneurs who will try to build businesses, small or big. Just an example, right? I don't want to be racist or nationalist, but like how many Philippines is a big BPO market, right? They have a well-educated workforce, but how many Philippines owned BPO companies, probably half of the BPO workforce probably works for an Indian BPO company or Indian IT services company, right? So I think, I don't know about the level of the market, but I remain very optimistic because inherently it's a very entrepreneurial country. Mm-hmm. And maybe that is because we have to exist despite the governments, right? So we have had like not so great governance track record, right, over the last 60, 70 years. But people are just resilient, and then they innovate their way around and they create value. So it doesn't matter where the Sensex goes or the Nifty goes. You'll find enough good corporates to bet on. That's my view.
Right. Rajiv, maybe to end the podcast, would love your views on how all of this is essential for India's growth, right? I mean, like large investors, hedge funds, etc., how would they aid India's growth?
So I'm in agreement with Dhiraj there quite a bit that India is a very ripe market. It's scalable. There's a volume, and then there's a lot of innovation which can happen there and is already happening. And I think there will be continuous inflow of money into India. The other option, I think there is a close competitor which Dhiraj missed, which is China. But we see that the issue is they are not able to, if they grow too big, their wings are cut and they're put back in place. We saw that with Baba, and we saw with Ant Financial IPO. So I do think the money will keep flowing towards India. It is definitely an opportunity. I am definitely long India. I am not short US. I will be honest. Just for short term, I do go short because there's a lot of printing of money. It's a Democratic Party, and there are a lot of reasons for being not massively long at the wrong times. I am a trader, and but I'm also an investor. I do see them as two different roles. As an investor, I want to be long the US. I want to be long India. I want to be marginally long China, but that's about it. There's not much other than that. I do agree with Dhiraj on that. But as a trader, I do try to time the market. I don't think investors should, but definitely traders can. And that is how, right now, I think it is very frothy. I'd rather be flat to slightly short. So my trading instincts kick in, and that is the position I have.
Right. All right, guys, this was fascinating. A lot of, clarity on things that we have kept hearing over the last week or so. And thank you so much for joining, Rajiv and Dhiraj. This was a fun chat.
Great.
Thanks, Roshan.
Yeah, thanks everyone for joining us. Hope to see you on another podcast. Thank you for tuning in. This podcast was brought to you by the team at Bharatvaarta. If you liked this podcast, then don't forget to share, subscribe, and rate us on your favorite platforms. We're available on Anchor, Apple, Google, Spotify, Stitcher, Breaker, YouTube, and a host of other platforms. We started Bharatvaarta to facilitate long-form discussions on politics, policy, and culture. We don't necessarily endorse anything that was said in this episode. If you do wish to offer us any feedback on the content or anything else, do reach out to us on social media or get in touch with us on our website, www.bharatvaarta.in. The links are in the description below. Thanks again for tuning in. Until next time, stay safe, take care, and Jai Hind.